Welcome back. We're going to have a look at formation of a partnership in this brief recap. So for formation of a partnership, we have to go, of course, to the Partnership Act, and we start in there with Section 4 and look at Section 5. So let's open up Section 4. The section here we'll look at is Section 4.1. Now if we take Section 4.1 and we simply put it into a new document, let's have a bit of a detailed look at this section. I'll just enlarge it so we can have a look. And when you go through this, you can see there's three separate elements. We have partnership being a relationship between persons carrying on a business. The second requirement is that it's in common, and then it must be with a view to a profit. So if we take those three separately, you can see that there are three elements. And this is how you should approach this in a test situation. Work through the three elements separately, identify them, identify the facts that apply them with a brief explanation, and then apply and come to a conclusion. A business. Now you notice it says carrying on a business. It does not have to be a continuous business. One single event can be a partnership. So they just have to be in a business. The emphasis here is on a single business that all are involved in. Now the options, if you had say three people, will be one business. You could have two businesses where two people are working together and the third is working for them. Or you could simply have three businesses that just cooperate. Oops. So we have to ask the question, are these people working together in the single business? The second requirement is that the second element, I should say, is that there is an action which we can describe as being in common. Now, this is called mutual agency. And to be in common, each person is taking actions and doing things which are on behalf of the others. Now, if we take an example of a sales agent, that's not right. They sell on behalf. Having trouble typing today. Behalf of a manufacturer, for example. So they act on behalf, but what does the agent, what does the manufacturer do for them? Well, the answer to that is nothing. They pay them, of course, but that's part of the contract. But there's no two-way action going on here. It's simply the agent doing things on behalf of the manufacturer to sell their product, and the manufacturer supplies them with the product. So in no way can you say that the two are working together on a single business where they both make money out of that business. The agent gets paid a percentage of whatever they sell. So that's quite simple. The third one is view to profit. And the key is intention. So when we look at this, we're not talking about an accounting profit and loss statement. So we don't take a gross revenue, deduct the operating costs to get our gross profit, take off our depreciation overheads to get a net profit. All we need to be saying is, are these people intending to share what's left after they have paid the expenses? Now, they may have their own vehicles and they pay the running costs in the vehicles. They may have their own premises and pay the lease costs. But then they may also share in the electricity costs, the direct petrol costs without depreciation on the car. And so they take the gross revenue of selling the combined product and deduct some set of agreed costs to end up with a effective net position. These people will be showing their intention to profit, even though it might not actually be a profit in that sense. Once we've been through section 4, then section 5, presumptions. The presumptions in section 5 are that a presumption is something which is true unless it's proven to be false. So we look through those and we decide, do any of these presumptions help us determine if there is a profit? But at the end of all of our analysis, we simply come to a conclusion on the facts. Can we identify this single business? Are they doing things for and on behalf of each other so that they can all make a profit together? And are they arranging things with an intention, if not the actual fact, of sharing in what's left after paying all the outside creditors and or employees? So let's have a look at those presumptions. So if we go from section 4 to section 5, you can see here there's quite a few of them. So let's just work through them briefly. Joint tenancy, tenancy in common. This is simply about common ownership. So if people own property together, it does not by itself make them partners. You might have people owning a farm. One's an investor, one's the farmer, and they share the profit. That would not normally be considered a partnership. Although there's profit and there's common ownership, they're not really working together on the single business. Notice in section 5b, the sharing of gross returns does not in itself create a partnership. So the presumption is if you share the revenue received, in other words, just the total sales price, you are not partners. And this is made further clear by C, receipt by a share of the profits, which has been interpreted to mean net profit, is evidence, prima facie, which means on the face of it, that he or she is a partner. So if you do get net profit share, you will be presumed to be a partner unless you can show that you are not. Underneath 5C are a set of circumstances where people who do receive a share of the net profit are not considered to be partners. For example, a receipt by a person of a liquidated amount by installments. If I'm owed money by a company a partnership, and they can't pay me, how should I get paid? I could ask them to pay me $100 a week, or I could ask them to pay me 30% of their net profit per week. In that case, I would be receiving the net profit of the partnership, but I'm not a partner. In 5C2, remuneration of servant agent, which is 1908, speak for a employee. It's common to pay employees a percentage of profit as part of their salary or wages. They're not partners. A surviving widower. This is the civil law or married partner or de facto partner of a dead partner in the firm. And under the partnership agreement, sometimes people receive an ongoing share of the profit. In other words, an annuity or annual payment. That person doesn't become a partner simply because they continue to receive a share, which was the entitlement of their deceased life partner. In 4, if you lend someone some money and get paid by profit, that doesn't make you a partner either. And the last one, a person who gets an annuity, the annual payment, as a profit for the sale of the business is not a partner. These are common ways to sell businesses. Well, if we turn now, just have a quick look at an example of this. If I bring up an example. So are these people in partnership? A manufacturer of gates works with a security firm to supply a package of gates with security equipment, and they single quote for the package and get paid their costs individually. Do we have a single business in this? Now, you can identify that we have a manufacturer of gates. So that's one person. Just highlight that. And a security firm who supply the security equipment. So it's two companies. So we have two businesses combining a product. Is that a partnership? when you look at this carefully, it's not really creating a single business of security gates with security equipment attached. It's just joining two products together, very much like you might join a computer with some software. Also, they're paid their costs individually. So these people would not be partners because we lack the single business. We also lack the profit motive from the business. They make their profits from their individual businesses. So the manufacturer might make a profit while the security person makes a loss. Whereas if they are partners, that's not possible. They profit and loss together. In the expansion of this, they lease a new building and both work there to produce their goods. They pay half the lease each. This is starting to get a bit closer, but they're still operating as separate businesses. Take it a bit further. They hire an accountant to work for both of them. Still two separate businesses. They're starting to share resources a bit more, but we could assume that they pay the accountant based on how much work the accountant does for both of them. Even if they simply share half the salary of the accountant, they're still not moving into a partnership. They integrate their manufacturing and have one cost for the final product. They jointly manage the process. This is getting very, very close. It could be difficult to argue it's not a partnership, but if we are very objective about this, we'd say they are working together. They've got some efficiencies by making their businesses manufacture the gates and the security at the same time, and they're jointly managing it. This jointly managing means they're working in common, but they still have two separate businesses, arguably. Now, if you got this as a question and you said they've integrated so they've got a single business and they're working in common, that would be a reasonably good answer. At that point, you'd have to assume, well, are they sharing gross revenue or are they sharing net revenue? Gross revenue, probably not a partnership. Net revenue, a partnership. However, even then, that could be argued to be a partnership because there's an intention to work together and profit jointly. So it's one of those situations which would be very hard to answer in a test, but all you would do is follow through the steps. Is there a joint business, single business? Are they working together? Yes, yes. Overall, even though it's gross profit, do you think it's a partnership? And make your conclusion. And we'd be very happy with that answer. They share profit from each joint project. They continue to work individually on other work. This is a partnership. They are sharing profit now. So that's the third part from the previous facts that would create the partnership. Continuing to work individually on the other work, if they've agreed to do that, that's fine. If they haven't, it's actually a breach of the Act. Combining businesses totally, yes, of course, that's going to be a partnership. Now, in our discussion questions, we had this question of Bill and Bill, Peggy, and Bob working together. Now, this is a classic situation where you could argue there is one business of manufacturing, bundling software, and selling, but it's a very strong argument in here that Peggy's not a partner. Bill and Bob are working together, and Peggy's going out and selling the product. But when you start looking through these facts, you can see that they have a sharing of profit. They receive their costs, so they pay the actual costs of manufacture and distribution. They will then divide the balance of the sales money equally. In the case of Bill and Bob, they're in partnership because we have all three elements. In the case of Peggy, we could argue she's got a separate business. But when you build in this, they will then divide the balance of the sales money equally, you could argue she's a part of the partnership. So again, this is one of those questions where you could conclude in many ways. The key issue here is that you follow the steps. Identify the three businesses they're currently doing separately. Ask the question, are they combining one, two, or three of these together to create a single business? Then what are they doing on these facts for and on behalf of each other? Are they working together in each and all parts of the business? And this again is difficult in this question because you can't really see where Peggy is doing that. So simply point that out. In the third part, there is an intention to share net profits, which overall you could conclude it's a partnership. On the other hand, you could conclude it's not, and we would be quite happy with that. In the next video, we'll have a look at liability issues. And I'm going to push stop.